Make no mistake, the global debt market completely dwarfs the world's equity markets in both absolute size and structural complexity. Nominal coupon rates provide the headline figure, but omit the structural data required for a complete valuation. A precise evaluation relies on three distinct pillars: the mathematical baseline of returns, the intricate legal indentures that govern cash flows, and the geopolitical frameworks of the specific issuer. To accurately price these instruments, we have to systematically map this ecosystem. That means starting with the bedrock math and layering on the structural realities of the market. Total return is a dynamic figure, determined by multiple moving parts rather than a static annual payout. This formula represents the holding period return, or HPR. It is the primary engine for calculating the actual performance of a bond over a specific timeframe. The int variable represents the specific interest payments, or cash flows, distributed to the holder during that period. Alongside that periodic income, we have PT+1, the market price of the bond at the end of the period. This tracks capital appreciation, or depreciation, which fluctuates constantly on the secondary market. By combining price action with interest income and dividing by the initial price, we get the total return ratio. Subtracting 1 from this holding period return gives us the holding period yield, the actual percentage gained or lost. A primary driver of these inputs is the bond's term to maturity. The market segments these into 3 categories: short-term money market issues maturing within a year, intermediate notes taking 1 to 10 years, and long-term bonds extending beyond a decade. The remaining life on that timeline directly impacts price volatility. The longer an investor waits to recoup their principal, the more sensitive the bond's market price becomes to interest rate changes. Therefore, the baseline mathematical return of any fixed income asset is dictated by its time horizon and the resulting volatility of its price. The theoretical math of HPR is often interrupted by the external legal forces found in indenture provisions. An indenture functions as a set of rules that physically alter scheduled cash flows. A standard straight-line timeline can branch off based on specific clauses triggered by the issuer. A callable provision allows the issuer to buy back the debt before maturity. If the timeline terminates early, the issuer pays a call premium to compensate the investor for the loss of future interest. This introduces reinvestment risk. Investors seeking certainty look for non-callable bonds or deferred call structures that guarantee protection from early redemption for a set number of years. Other indentures include a sinking fund. Instead of returning the entire principal at the end of the term, the issuer must systematically retire the principal piece by piece over time, reducing the ultimate default risk but altering the outstanding capital. Indentures also establish the hierarchy of claims if the issuer faces bankruptcy. The seniority dictates who receives payment first during a liquidation. Secured or senior bonds are backed by physical collateral, placing them at the top of the line. Unsecured bonds, known as debentures, rely strictly on the issuer's general creditworthiness. At the lowest tier of protection are subordinate or junior debentures. If the company fails, these holders only receive payment after all senior claims are satisfied. A bond's theoretical yield is only as reliable as the specific legal indentures protecting its timeline and its position in the capital structure. To manage this complexity, we categorize the market by its 4 primary issuer types: sovereigns, agencies, municipalities, and corporates. National governments issue massive volumes of domestic debt. The United States issues T-bills, notes, and specific inflation-protected securities, known as TIPS. Sovereign structures vary by country. Japan issues long and super long-term bonds, while Germany issues Bund bonds within a liquid market facilitated by the Bundesbank. Separate from direct sovereign debt are agency issues. In the U.S., these take the form of pass-through certificates from groups like Genema. Germany funds infrastructure through organizations like the Federal Railway and Federal Post Office. Shifting focus to the corporate sector reveals a denser subset of structural variations. Here we find structured asset classes pulling individual loans together, such as mortgage-backed securities and the highly complex collateralized mortgage obligations. Corporations also issue zero-coupon and deep discount bonds. Because they pay no periodic interest, investors buy them at a steep discount to face value. However, the holder is still liable for taxes on the implied interest each year, even when no cash is received. Risk profiles in the corporate space are explicitly graded by rating agencies. Any issue carrying a rating below BBB or BAA is classified as high yield or junk bond territory. Beyond domestic borders, geopolitical rules dictate international issuance. Foreign bonds are issued in a specific country's currency by a foreign borrower, like Yankee bonds, which are dollar-denominated, but sold in the U.S. by an overseas firm. By contrast, Eurobonds are underwritten by international syndicates and sold across multiple national markets, insulating them from the regulations of any single domestic currency. Sovereign legal structures and unique issuer types dictate the risk profile of otherwise mathematically identical bonds. This brings us to municipal bond market. Whether structured as general obligation or revenue bonds, these instruments are defined by their exemption from federal income tax. Comparing a tax-free municipal yield against a fully taxable corporate bond requires a standardizing calculation. This equation displays the equivalent taxable yield formula, which creates parity between different tax environments. We take the municipal tax-free yield, represented by I, and divide it by 1 minus the investor's marginal tax rate, T. This tax rate acts as the dynamic lever in the calculation. As an investor moves into a higher tax bracket, the comparative value of that tax-free municipal yield scales up dramatically against a taxable alternative. While municipalities carry default risks, private carriers like MBIA or AMBAC often insure these issues. This insurance raises the rating to AAA, ensuring a more active secondary market. Tax frameworks construct a parallel pricing universe. For investors in specific brackets, a lower nominal coupon on a municipal bond will out-yield a numerically higher corporate coupon. The complete analytical model establishes the baseline math with the holding period return, filters cash flows through the rules of the indenture tree, maps risk across the global matrix, and adjusts for the investor's tax environment. Bond performance is a function of the underlying legal contract. Yield analysis requires the simultaneous mapping of duration, indentures, and tax environments. Mastering this layered taxonomy is the prerequisite for advanced portfolio management, allowing investors to isolate true return in the global debt market.